All right, it's up and running. Just double check. Okay, great. All right, can you see the screen? Hey, Learning Unit 6.
Yes, I can.
Okay, perfect. So this week, we're wrapping up the last two sections. The ones looking at capital budgeting, so net present value and all of those workings in financial management. And then in Learning Unit 6, you're starting here with valuation, so applying different time value of money concepts practically in a specific context, so either looking at bonds or looking at shares, depending. And you can also calculate things like weighted average cost of capital and so on. So Excel is just a powerful tool that can help us with record keeping. When it comes to actual, let's call it data regarding prices, so you could download maybe a list of prices on bonds and how prices have fluctuated over a certain period of time, or you could do the same thing with dividends, okay, or shares, share prices. You could get a set of data that highlights how the returns are, or what the dividends are, or maybe the changes in price over a period of time. It all depends. But with that data, with that information, we can then build an Excel model. Okay, we can model a formula to do various calculations, maybe looking at sensitivity. Okay, so when we looked at bond calculations in the I&V modules, they spoke about bond duration and convexity. All right, those are all financial management and investment management measures that can help you with making decisions. All right, so you're going to see a lot of the investment management come up. And just remember, when you're looking at investment management, the most important thing to remember is context. So obviously, you're going to make a decision based on what the data is showing, either underpriced, overpriced, or fairly priced, depending on the situation. All right, so that's just a general outline. I see they've given you a few key concepts that you need to understand, and then they've referred you to different chapters in the textbook, highlighting the different measures that you can calculate using Excel. Okay, so I'm just going to go through this list and just ask you if you remember these concepts from I&V. There's a lot here, so you can tell me which ones you may be unfamiliar with. In the notes that I sent you, I do have some like revision notes just highlighting the most important sections. For example, here we've got the Gordon growth rate or growth model, highlighting the dividend discount formula when looking at present value when I have dividends, so future dividends, when there's a rate, okay, for return on equity, and then G is the actual growth in the actual dividends. So these are different formulas that you've seen before in various other modules. And they also talk about two-stage, three-stage. You can have multi-stage dividend discounting models. It's all looking at time value of money, taking individual dividends and discounting it back in time. All right, and then when looking at bonds, same concept applies. You've got this time value of money principle, and we've got these bond coupons, and these coupons are going to be taken back in time. All right, and then we're going to find a PV. Remember, PV in bond calculations representing the bond price. Same thing with dividends. Discount dividends back in time. PV or present value will represent the price. All right, so there are some general slides here, notes just highlighting things that you would have covered previously. The bond duration, okay, this you looked at in I&V, is just looking at the sensitivity of the bond price in relation to the changing interest rate. So remember, bonds are discounted back in time because a bond is a promise to pay. All right, so very similar to this in terms of future payments. So when a company issues a bond, they're basically creating this contract and they're saying, okay, I promise to pay you coupon payments every single period for however long. Okay, it could be like 20 years if it's a 20-year bond. And I'm going to return the face value, okay, of that bond at the end of the life of that bond. But today, there's going to be a price for this particular bond. So bonds can be bought and sold based on their price, okay, and bonds are priced based on the current prevailing interest rates in the market. Okay, so this is very important to remember just in terms of theory, because Obviously, if rates are higher, then when I discount future coupons and a future par value back in time, I'm going to get a lower present value, right? So there's that inverse relationship between bond prices and interest rates. Okay, and you can measure the sensitivity of a bond with relation to the changing or the prevailing interest rates. So if interest rates continue to fall or continue to rise, what will the impact be on a specific bond? Okay, remember, not all bonds are created equal. Some bonds have higher coupons. Some bonds have a longer maturity or time frame. Some bonds, okay, trade at a discount or a premium. So depending on the type of bond you have and the characteristics of that bond, certain bonds could be more sensitive to a change in price or less sensitive to a change in price. And if you're an investor, obviously you would be looking at bonds, okay, in various market conditions, depending on the prevailing interest rates and what you expect going forward. Right. So if you expect bond prices, if you expect interest rates, right, to increase, then you would expect bond prices to decrease. Right. So in a rising interest rate environment, I'd be looking at getting more exposure to bonds because those bond or less exposure to bonds because those bond prices are decreasing. Whereas if the interest rates are going to fall, so in a falling interest rate environment, my investment, my bond price, the price that I've paid, okay, will increase, right? So those are just two different considerations, okay, in terms of shares and bonds. And then you've got these different sensitivities that you need to provide for. Okay, so it's quite a long list. I've spoken about the bond valuation, valuing bonds between coupon dates. So there you get an all-in price or you get a clean price. There's different prices that you can calculate when looking at bonds specifically. So this is actually touched on a lot in DSC, which one was it? 1630. 1630 is the financial maths one, and then they talk about the bond valuation in there. Okay, I'm just going to check here. Sensitivities, we've talked about that. Duration, we spoke about the price sensitivity of a bond. Convexity and duration are similar. Okay, they speak to the same thing in terms of price sensitivity in relation to changing interest rates. Okay, they're a little bit different because you do get different types of duration and convexity. So you just need to decide, okay, what is being analyzed? Okay, what are we checking or what are we measuring? Okay, are we measuring the convexity or are we measuring the duration? Okay, and are we modifying it in any way to get a better measure of it? Right, then you've got the dividend growth model, two-stage, three-stage, or multi-stage, it doesn't matter. Okay, we spoke about shares and how shares can have different expected dividends, okay, in terms of the growth going forward, or they could be more, let's say, not as constant. Okay, so changing dividends and then maybe finding a certain trend, perhaps. Two-stage, maybe we could be increasing dividends to a point and then it stays the same. Or it could stay the same for a bit and then it increases, whatever the case might be. Three-stage, there could be three different stages. Maybe an increasing dividend, then it like plateaus out and then maybe it decreases perhaps. But it all depends on your expectation. They just describe the different stages so you can do a time value of money timeline in order to calculate the dividends and discount them appropriately. But then you've got different forms of equity, preferred debt or preferred stock. Then you've got cost of debt, which is your weighted average cost of capital, looking at debt and equity. All right, so looking at this list, are there any concepts that you're like really unfamiliar with that you want me to elaborate in more detail? I've just really covered it like quickly and just a very high level summary. Anything on that list that bothers you that you want more detail on? Concepts that you might not be so familiar with?
I think it's just more the bond concepts because
Okay.
like the ones on the left, I know I've done like in all my previous modules. They're quite
Okay.
familiar to me, the equity and
Yeah. All right.
yeah,
So
concepts.
Maybe just to highlight a bit more information here. So with duration here, right, you're looking at a measure. Okay, so effective duration is actually one of the better methods that they use, okay, to value a bond's durations. In other words, their sensitivity to a change in interest rates. Okay, the effective duration is looking at a 1% change in rate. So if the rates don't fluctuate too, let's call it severely. In other words, you're not going to wake up one day and then the Reserve Bank is going to say, well, current interest rates, well, prime in the country at the moment, they haven't changed for quite some time now. The prime interest rate in the country is 11.25%, right? And that obviously hinges on the Reserve Bank's policy around the repo rate. Okay, so the repo rate is what the Reserve Bank sets, and that's a change in interest rate. So if they change the interest rate, the repo rate, that's going to filter through to the prime interest rate, which is what you and I, as consumers or clients, people, are going to apply for, okay, when we apply for credit at a financial institution. So this 1% change is generally what's used, because if if the Reserve Bank changes the repo rate for commercial banks, then they're not going to really jump, okay, massive increments. So they're not going to say, well, okay, tomorrow we're going to change interest rates by 5% or like 10%. That's unheard of in South Africa, right? In other countries where there's problems like hyperinflation or an eroding currency, for example, Zimbabwe, but that's like many, many years ago. But more recently, if you do some research, Argentina, they've had some massive political issues and problems, and they've got a very, very high interest rate because of their weakening currency and the unstable political environment. So from time to time, it can happen where you've got these massive 5% or 10% changes in rates, but it's not often the case, right? Those are very, very unusual and exceptions to the rule. Generally, okay, rates will maybe move by 1%, maybe 0.5%, 0.25%, something like that. Okay, so when we're looking at a rate, all right, we want to keep it, how can I put it? Maybe easier to interpret, because a 1% change, okay, it's a nice whole number that we can use, right? So if we expect a bond or the interest rates in the market to change by 1%, then what would we expect the price, okay, to happen? In other words, what extent, okay, will the price change if the rate had to change by 1%? So duration, it's a measure. You will get like 1.5, 2.5, 3.5, whatever it is, okay? But that measure is not explaining the extent in terms of how much the rate is going to change, okay? It's just giving you an indication of how sensitive, so how much the rate is going to change by. So, for example, like think about it like the weather. If you've ever watched any like weather forecasting on maybe the news, perhaps, and then they normally share weather from time to time. If you watch any good news broadcaster, on those channels, obviously they give you like a measure. Like they might say, well, humidity, there's a measure for that. Okay, and obviously, if the humidity is high, then we could possibly expect maybe a higher chance of rain. Okay, so we're looking at one measure, but we're looking at a measure for something else. So, for example, duration is a measure for the sensitivity. Okay, when rates change, how or what's going to happen to the bond prices. So we're measuring one thing that's giving us an indication of another thing. In other words, it's just like a signal. It's like a indicator that just shows us, okay, this is a potential, let's say, concern. If I'm the investor and I'm investing in bonds and the duration might be very high perhaps, then I know as an investor, if anything happens to interest rates, then I must expect a very, very big change, right, in my price for my assets that I'm holding. So if I'm holding bonds, then those bonds will change significantly if their duration is quite high versus if they were quite low and they weren't very sensitive to a change in rates. All right, so if rates are very volatile and rates are changing a lot and often, then you might want to maybe reduce or find bonds that have a lower duration that aren't as affected by a change in rate. Okay, so they are different. So Macaulay's, if you go do some research, you get different economists, mathematicians, people that analyze numbers, data, and sometimes they try create better measures or more accurate measures to help them with their decision making. So if you bought any of those CFA textbooks that the INV 3701 prescribe or the INV 3702, the one is equity asset valuation and the other is bond valuation or fixed income valuation.
Fixed income.
Yeah,
Yes.
yeah. Then those two textbooks, if you've looked at them or you've managed to go through them, you'll see it's a space where individuals can come up with better measures to predict things that happen in the market. And that's why Excel is so powerful, because it allows you to do calculations, but it allows you to do pricing, it allows you to do costing, it allows you to find arbitrage. So the word arbitrage refers to a mispricing. So arbitrage would be being able to find a bond, okay, that is priced, right, or mispriced, right, by a certain amount, and buying the bond maybe in one market and selling the bond in another market. But that is possible. So arbitrage speaks to the hedge fund world. Okay, so I don't know if you've heard about a hedge fund, but a hedge fund is basically a fund that looks at generating returns in all situations, depending on what the market is doing. And they use a lot of derivatives. So if you've done INV 3703, the third module, that's a derivative module where they talk about options, they talk about pricing, arbitrage, all of that. So arbitrage is just that. It's being able to do a calculation in terms of mathematics, but big data. So lots and lots and lots of data, and trying to find these opportunities in the market where we can make a profit based on the mispricing. Okay, because everything in finance is priced according to a valuation model. So when you're looking at this section, valuing assets, okay, the heading here, financial assets, right? Everything in the finance world, investment world, right? It's all based on a model. It's all based on a mathematical calculation. And if you have a very sophisticated model, you might be able to find opportunities where you've been able to price, let's say, shares or equity more accurately than somebody else. Or you might have been able to price bonds more accurately, again, compared to someone else. Right, but no one knows exactly what the price is supposed to be, right? There's always your view, and then there's the market. So if your view is the market is undervalued, then you might say, well, okay, this is a good opportunity to buy certain bonds. And if we expect bonds, okay, if we expect the interest rates to fall, then we would expect the bond prices to rise. Then we would say, well, okay, duration convexity, we should get exposure, all right, to more sensitive bonds, right, if that's the expectation, right? So it's always based on a calculation. And this is what they're trying to explain here. They're just trying to highlight the use of mathematics to highlight the opportunities or the arbitrage in terms of pricing or mispricing, and you can maybe use that as an opportunity to buy or to make a better decision to buy so that you, as the investor, could most likely make a return. Okay, so duration, convexity, all of these points. We've looked at that. Here's convexity. This is the bond curve. Okay, so if you've ever looked at the bond curve in the fixed income textbook chapter, okay, the bond curve, you have a flat curve, you have a inverse curve, you have a normal curve, and these curves give you almost like an insight in terms of what could happen going forward. So with convexity, they're looking at that like the curvature of the bond. So I sort of draw something here like this, right? Or like this, right? Or it could be just flat, right? It all depends. So we're either going to expect rates to rise or fall depending on the situation. And this yield curve is something that's used in economics to predict if we're expecting a recession, okay, the market's going to decline, or a possible boom or expansion. So this yield curve, okay, in the fixed income module, the FIN3702 module, right, they talked about like expectations theory, okay, as a tool to help you with pricing bonds. And obviously this yield curve is important. And if you were an asset manager and you were looking specifically at bonds as an investment, then you would definitely be analyzing these yield curves in the market, right? You'd be looking at all the different interest rates on all the different bonds, and you're going to be looking at all the different prevailing interest rates in different countries, and then you're going to be deciding, okay, is the curve sloping normally? Is the curve inverse? Like, what is happening to this bond curve? Because if rates are rising or falling, okay, depending on what's happening, that's current information. But this curve, the curvature of the bond, is going to give you a little bit of an indication or a prediction of what could potentially happen going forward. Right. So in that textbook, in that chapter, in that one chapter in that textbook where they talk about these yield curves, it's used as like a prediction or an indicator in terms of future, let's call it future potential changes in pricing, right, or prices in that market. Right. So whenever you make a decision, we spoke about the importance of data and information long ago when we started this module. Data is very powerful and very useful because you can use it to make decisions, but you need to analyze the data in order to get a better understanding of what's actually happening in the big picture. All right. So with AI and all these tools that are coming up, this tool, AI, can help you with calculating certain measures that can maybe help with making decisions. So Excel, for example, is a form of AI. Okay, it's a very basic form of AI because we create the models, but then it does it for us. So it's almost artificial in a way because it's inbuilt, it's created, and that's why you have all these functions. All right, but obviously it's not intelligent enough yet to analyze the market itself. Okay, I think I did see something in like a news website, or it was a post or something like that, where they were talking about how future investment firms and banks and all of those companies are going to rely more on AI to make investment decisions rather than people, because it's becoming so good that we can use a machine to give us a investment opportunity or recommendation, because the machine, the computer, the AI can do all of these calculations for us. All right, so just understand that with the bond, okay, these calculations just measure something. Right, so the convexity is referring to the yield curve, right, the shape of the actual bond. Okay, and convexity, all right, and duration are both used to determine what the actual percentage change is going to be in terms of bond price. Okay, if you combine the two effects together, duration effect and convexity, right, you can get a very, very good, accurate indication of a potential change in price. Okay, is that all right?
Yes, thank you.
Okay, so that's just a very like high level overview of the bonds. Okay, obviously I would recommend, not, sorry, I wrote FIN here. It's INV. Okay, wrong one.
Yes.
Yeah, INV, not FIN. All right, INV, the investment module. All right, so let's get to some of the workings, and we can see that the Excel work as well. All right, so first thing, bond valuation. Okay, we looked at this previously when we looked at time value of money. Okay, time value of money, you're going to see present value a lot. All right, especially with valuations. Okay, a valuation, remember, is a prediction, right? It's an estimate. And the nice thing about a bond is it's a contract. So because it's a contract, right, you know what the yield is or the term is. Okay, you know what the coupon is. So there will be an interest rate, there'll be a face value, okay, and there'll be a coupon. Right, obviously there'll be time, so N. Right, with those four variables, N, PMT, I, and FV, it's possible to value a bond because we can apply time value of money discounting. All right, so whenever you're doing any form of valuation, doesn't matter what form of valuation, bonds or shares, you saw those diagrams earlier, we're just discounting things back in time. Whether we're discounting coupons or whether we're discounting dividends, okay, in terms of discounting, it's the same principle. Okay, time value of money requires these time value of money variables. Okay, N, I, PMT, PV. All right, and what FV? What you want is the PV. Okay, the PV is the current bond price. Okay, or the value of that particular asset. Okay, so all the other things will be highlighted in the contract. Okay, a bond has a contract. They're all contracts. You create these bonds. Corporates, big businesses, they issue bonds. That's what they talk about. Okay, when they issue bonds, okay, they're actually raising capital, right? That's a financial management decision, actually, all right? When I have debt and equity, okay, so debt or equity, all right? So just to like bring in the finance now. So now we're talking about the FIN 3701, okay? When businesses are issuing bonds, they're looking at the debt aspect of their financial management, okay, when they're raising more capital, right? Sometimes it's better to use debt depending on what the market looks like in terms of rates, right? If rates are very, very, very low, okay, so for example, coming out of the crisis in 2008, okay, there were lots of businesses that were issuing bonds, okay, because it was very cheap to issue bonds. Okay, rates were at their lowest, and then obviously rates have changed, right? And then COVID again, 2020, same thing happened basically. The market crashed. Okay, everything came to a standstill. Right, rates again went very, very, very low. Okay, and then that started a whole like money raising, like fanatic, or like it became a bit crazy. Okay, everyone was fanatic about bonds, 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 bonds this, bonds that, issue more bonds, raise more capital, right? But then obviously since COVID, what has happened? High inflation, right? You can't obviously have such a lot of money in the system. Okay, if companies are issuing bonds, right, they're creating money. Okay, they're creating these liabilities, right? And that's a problem. So with valuation, everything's looking at present value, everything's looking at a contract, everything is done today when you issue the bond, okay, based on the current situation, right? And then as you continue living through 2021, 2022, 2023, and so on, okay, the rates will change, all right, but those bonds still exist, right? Because in 2020, I could have issued a bond, okay, and that bond's going to exist or run for maybe 5 years, 3 years, 4 years, 10 years, 20 years, whatever it is. Okay, you do get long-term bonds and short-term bonds, right? But the whole point that I'm making here is that it's all based on time value of money, and it's looking at data that's currently in the market. Okay, so we need to use the prevailing interest rates. We need to use all the different, let's call them variables, for time value of money, okay, to work out the PV. All right, so valuing bonds between coupon dates, okay. All right, so in your actual study guide, I see here they've given you, okay, present value, all right, but they haven't given you a specific formula because there isn't one. Okay, remember we just said this is discounting things back in time, right? So when you go to Excel, okay, present value, if you type in present value, other way around, okay, and you open the brackets, right, see, it's going to ask you what you're going to insert. All right, so when they say rate, if they're asking you to put in a rate, this is referring to the current I that's present. So in other words, the yield to maturity. Okay, so when you want a rate, let me just write that down. So rate is I, term, N, coupon, PMT, face value, FV, okay, and then PV is price, bond price. Okay, so it's basically just normal time value of money. The only difference is when you're reading this actual formula. So let's type it in again. Okay, you need to remember that this rate is referring to the I, or the yield to maturity. The N is the number of periods or term that this bond is going to be issued for. The coupon payments are those, okay, those actual semi-annual or annual payments that need to be made, okay, the actual interest payments. And those coupons are calculated using a coupon rate. Right, this is stuff that you need to remember from before, coupon rates. Right, so coupon rate times face value, okay, is going to give you the bond payments. Right, and then you've got future value, which in this case would be the face value or the par value at the end of the life of the bond, okay, and then type is just referring to when the payments are made, either at the beginning of the period or at the end of the period, and that's something we need to consider. Right, so are you okay with this function? We saw it previously, but we're just relating it to bonds. That's all we're doing.
Yes.
Okay, so just remember that when you're looking at content. Let me just highlight that. Okay, minimize it. All right, so when you're looking at valuing a bond, okay, on the coupon dates, then you're either going to have to move the bond forward, all right, or back, depending on when you actually have the coupon. Right, so I don't know if you've done this before, but I'm going to explain it. Let's assume bonds are paying a monthly coupon. Okay, so month one, month two. But now the problem is, what happens if I buy the bond somewhere in between? Okay, what price am I going to pay for the bond? What do you think? If I don't buy it exactly on the coupon date,
I think you would have to include the month one's coupon. No.
okay, almost. All right,
Okay.
if you bought the bond here, okay, in month one or before month one started, then if you're the owner of the bond, okay, you'd be entitled to the coupon, the interest. Does it make sense?
Yes.
Right, so depending on what time you bought the bond, you are going to be entitled to a little bit of the interest or the coupon payment. Okay, the coupon payment is basically the interest. Right, so they talk about this concept of accrued interest because, okay, with time value of money, you can only work out the price at a specific point in time. And when I'm looking at this point in time, right, on that point in time, but if I buy it just before the bond, okay, has paid out the coupon, then I could potentially get the coupon. Okay, it is a lot more complicated than this because it is dependent on the number of days. Okay, there's like an all-in price. Okay, there's a clean price. Okay, these are different prices that are used to establish whether you have a portion of the interest or not. Okay, so if I bought the bond here, okay, let's change color quickly here. Okay, if I bought the bond at that point in time, okay, because I'm now the owner of the bond at that point in time, surely I should be entitled to a part of the interest, even though the interest is only going to be paid out here. Okay, so the coupon is only going to pay out on the next day of the month. Okay, but because I bought the bond halfway through the month, then technically I'm entitled to some of this interest. Does it make sense?
Yes.
Okay, and that's this whole concept of accrued interest. So whenever a bond is calculated, right, it's always moved to a specific point in time, either the beginning of the month or before the coupon or on a specific date, right? And then you need to provide for this accrued interest, okay, as an additional amount that needs to be provided based on the information in the question or based on the timing that's present, okay, because this price, okay, needs to be calculated based on the current prevailing interest rates. And remember, what even makes it more complicated is bonds are priced daily, okay, and they use a yield to maturity as well, right? So it will fluctuate all the time, constantly. It's like the share market, it's constantly fluctuating all the time, okay, but we need to try to find a price for it, taking the contract into consideration. And that's why earlier I spoke about mispricing. But arbitrage is trying to buy a bond, okay, that's priced incorrectly, right? Because somebody, the dealer, okay, the dealer is the person that helps to create these markets, okay, so normally like an investment bank, okay, the investment bank would be a dealer perhaps, okay, and they could issue these bonds or sell these bonds that they perhaps have, okay, as part of their assets, their financial assets. Right, so when we're looking at this, right, there's a round up and a round down function that you can use, okay, to round off, okay, these amounts that you have currently. So here they're asking you to use the round up function, okay, function rounds a number upward. All right, and it's described as round up or down. Okay, the only reason why they do that is because it's impossible to get an exact price for a bond. Okay, so they use a estimate, and then they either round it up or they round it down. And that's why with arbitrage, if you do some research, you'll see arbitrage. They use arbitrage, but arbitrage is done on a very big scale. So, for example, okay, if you've got, let's say, like 100 million as a portfolio, okay, let's say you're going to invest 100 million into bonds, okay, all right. If you're looking at like a 0.01%, okay, difference in price. Okay, that's not going to be that much, all right, for a million. Okay, but for 100 million, it could be a lot more substantial, or even imagine a billion. Okay, if you've got a billion, all right, as a fund manager and you're investing in bonds, okay, the smallest of mispricing, it could be anything, a 0.01% of a billion is going to be a lot more, okay, than 100 million or a million. All right, so if we're looking at arbitrage, okay, if we're looking at pricing, that's what they're looking for. So a hedge fund, okay, is looking at these type of things. They've got lots of capital and they can take advantage of the smallest of mispricing. Okay, that's what you're looking at. All right, so a simple example I could give you is like, for example, even with like discounts for different items. Okay, a discount on an item would be an arbitrage or a mispricing opportunity. Okay, maybe you go to store B. Okay, in store B, you see they're selling a product A, or product B, we'll use B with B, product B, okay, and product B is selling for, let's just say 100 Rand. Okay, and then maybe like across town, all right, you've got another product A, in store A. It's the same product, they both do the same thing, okay, they're similar, or they're exactly the same, doesn't matter, but store A has the same product B, okay, but they're selling product B for 110 Rand. Okay, maybe it's a very difficult store to reach, it's far from a distribution center, whatever it is, and they're selling those items, same product B, but sold in store A for 110 Rand. Okay, this 10 Rand mispricing is an opportunity that we can do, but you're not gonna buy one product and sell one product. Okay, if you were the owner of store A, you would go to store B, buy product B from store B and sell it in store A at 110. But you're only going to make a 10 Rand profit, or you're only going to increase your return on investment by 10 Rand. So it's not going to make much sense to do it for one product. But if I had R1 billion and I could buy R1 billion worth of product B, assuming I could sell R1 billion of product B in store A, then I would do that. Does it make sense?
Yes.
Okay, and that's what you're looking at here in terms of this rounding. Okay, so businesses will round up or round down based on the valuation. Okay, there's the PV function again, all right, and then they've shown that rounded scenario. Okay, here they're referring to number of years. Okay, why? Because that's N. Here they're referring to coupon rate times the face value. See, times the face value. This is referring to the payment. Okay, then you've got what else do you have here? Okay, they've worked out the calculate the invoice price. Right, they've given you a formula looking at that to provide for this accrued interest. So it's just an equation coming from financial, portfolio management, okay, valuation, okay, just highlighting, right, what we should do when there's a coupon, okay, and if there is this interest that we need to take into consideration. All right, so here's the little note here. Okay, interest, invoice price, sorry, interest, okay, where you have accrued interest, you can either take it out or you can add it in. So you can include it or you can take it out, because this is that adjustment for the price. I think here they even had a little note about it. Here, we find the bond's cumulative value by valuing it at the previous coupon date and moving it forward, okay, by the amount of time that has elapsed. Right, so here, did I rub it out? Yeah, it looks like I did, hey? Where's that other? Yeah, no, I think I did rub out that other one. Yeah, it's not here. Okay, so when we have the price, okay, if there's the coupon, and there's the coupon, and that's on the month, and I buy here, okay, I need the price there, the PV. Right, so this is the price that I can calculate using present value, okay, bond calculations, discounting future bond payments back in time, then this little bit of interest, that interest needs to be added or included. Okay, if you take it forward, so if I calculate this, right, so if the price is here, if that's where the price is, then I need to take out the interest. All right, so you can either add the interest, you can either add the interest, include it, or you will subtract the interest, you'll take it out. Okay, so depending on where you are, okay, if you're here or there, you will either add or subtract the interest to get to this point in time, which is the price that you want at that time frame. Maybe let's call it T time. Okay, is that all right?
So if you forward, then you subtract. If you're
Yes. Yeah.
Okay.
So remember, a bond can only be determined in terms of price with time value of money at the coupon date. Okay. This difference in price is based on the interest. That's why you're adding it or taking it out. That's why you've got this calculation, this consideration for the actual interest. Right, they call it an all-in or a clean price. There's two different prices that they use to do that. Okay, you didn't do the DSCA, the 1631, eh?
No,
Yeah,
I did not.
all right. In that module, they actually work out those different prices using the financial mathematics. Okay, here I see they're just referring to, is there a page number for this? Yeah, all right, page 301, not 301, 307 to 110, 310. Let's go to the textbook, and I just want to have a look and see what they're referring you to. Okay, page 307. Let's see what they're asking you to look at. I saw a yield curve. All right, there's a really great bond yield curve on page 301. Okay, there, sensitivity to yields. Right, you've got the bond value and you've got the yield to maturity. You've got the current price. Okay, and you've got the yield curve, and you're calculating the actual amount. Okay, the bond. All right, that's a good example. Let's continue. Changing in yield curves, that's the whole idea of convexity and duration. Do they want you to cover page 301? No, it starts here. Okay, study bond valuation, page 307. All right, so we actually need to look at 307 onwards.
I think it's from 304, page
304. Yeah, 304 talks about the bond pricing. That's fine. Okay. Yeah, that's bond pricing, time to maturity. That's good. Okay. Okay, I'm going to use this example just to do some calculations here. All right, there's a really great example here on page 305 where you have all the information here. All right, the settlement date, the maturity date, the first call date, coupon rate, required return, all of that. So you've got these dates that you can provide for. Okay, maturity dates. Required return, redemption value, call price, frequency, basis. Okay. Right, so this is all time value of money. Okay. Right, so settlement dates. 15th of Feb. Okay, then you've got, it's a 20-year bond, 15 Feb, 2037. Okay, you've got the call date, first call, so 15 Feb, 2022. All right, the coupon rate is 8%. The required return is 9%. Redemption value is always 1, okay? All right, the call price is 105, so 1,000. So units of 1,000. Okay, call price 1050, frequency 2, so that's a semi-annual bond. Okay, and then they're looking at value. All right, and then you've got the yield. Okay, the yield. The yield, remember, is the current rate in the market. The yield to maturity.
Yes.
Okay, 9%, 12%. Okay, and then they want you to calculate these two bonds. Okay, using the information. Do I have the same information here? Yeah, except the dates are a bit different. This is a 10-year bond, 2027. Everything else is the same, yes. Okay. All right, so let's start with the value. Okay, so we need to calculate the bond, okay, based on the number of years. Okay, so what was my rate here? The rate was 8%. So negative. Oh, actually, I can use these things. Okay, we'll use the 8 there, but we need to make it a rate, so divide it by 100. Okay, needs to be a decimal. Right, the next thing is my n. All right, so my n is going to be the number of years. All right, so if I'm working out the number of years, let's think about this. Can I use a date function? Possibly, but then I'll need to do that separately. Okay, let's do that separately. Okay, let's just delete that for now. Let's just put in the n. Okay, we're going to add another calculation here. All right, so the term, we want the number of years. I think you can do this. Count returns the year of a date. No, that's not the right function. Let's just check it and see if we can find a function for this. I'm just going to quickly check and search for it. Okay. Okay, dated if. All right, so the term dated if. Come on. Dated converts a date, returns a number before after, returns a number of the date in the time code. No, dated if. Does that work? Nope, it's not working. Let's go back to the built-in functions then. Okay, we want a date function, date and time. Okay, returns the number that represents the date. Okay, converts the date in the form. No, day. Returns the day of the month. No. Returns the number of days. No. We want the number of years. Returns the number of days between the two dates based on a 360. Okay, this one we could use. Right, we could use that one. Let's just see if there's one for the actual years. I see the dated if function is not visible here. This was calculating the difference between the two. I'm just googling this to check for this function. We need an inbuilt function for the year. Returns the year of a date. No. Returns the year representing the number of whole days. Okay, so let's use this one. Okay, returns the number of days between two dates based on a 360-day year. All right, that's good. All right, returns the number of days between two dates based on a 365-day year. Okay, so if I have this starting date, okay, and I have this ending date, all right, okay, insert, I've got 7,200 days. All right, so how many years would that be? We need to work that out. So term in years based on a 360-day year. Okay, then this would be 720 divided by 360 gives you 20 years. There we go. Okay, so there's the 20 years based on the number of days. Okay, so I'm using the days function to work out the years after having used those two. So I can copy paste this here. Okay, all right, so from 2017 to 2027, that's 10 years, which is 360 days. Okay, those data sets are still the same. All right, now we can calculate. All right, so we have bond frequency. Frequency is 2, so it's semi-annual. Okay, so we need term in semi-annual periods. Okay, so term in semi-annual periods. Okay, if it's semi-annual, it'll be twice a year. So 20 times 2. Okay. All right. So then we have the N, we need the coupon as well. Let's add another line. Okay, the coupon payments. All right, the coupon payments is based on the coupon rate. So the redemption value is the fair value or the par value. Okay, par value or what is the other one? Face value or par value. Okay, times 8% times the coupon divided by 100. Because this is half yearly, divide by 2. Okay, so that would be a 40 coupon. Okay, this will also be 40 as the coupon. Okay, so we've got the coupon payments, that's semi-annual, right? We've got the number of periods, we've got the required rate, no, we've got the yield to maturities here, okay? And we have everything else. We've got the PV, the FV, okay, then now we can do the working. Okay, so bond one's price with the yield to maturity, okay? Yield to maturity of 9%. So PV, open brackets, the rate that I want to use is 8%, 8 divided by 100, comma. My number of periods was semi-annual periods, so 40 periods. All right, my coupon payment was 40. Okay, my bond price will come out as a negative because I'm using positives for my payments. Remember, payment and future value need to have the same sign. Okay.
Yes.
And then future value is the redemption value. Okay, close brackets, enter. Okay, so this is representing, we need to divide this by 2. Okay, this rate, it's 8%. Remember, it's compounded monthly, semi-annual, so divide by 2. So this should be 4%. Divide by 2, divide by 100. Did that work? Divide by 2, divide by 100. I hope that worked. Let's just put an extra bracket in case it didn't. Okay, so first divide by 2. Okay. All right. Okay, so the coupon rate, is it the same as the yield to maturity? No, the yield to maturity is 9%. So what did I put? Oh, I put 8%. That's why. That's the problem. Wrong column. Okay, we need to use this column. That column. Hold on. Okay, click there. Insert. Oh, what is that? C22. Okay, there we go. That's better. All right, now it's in line with the textbook. Okay, it needs to be in line with the textbook. All right, copy, paste. Okay, there's the other one, 934.96. All right, so you've got, that's the value one. Ooh, wrong column. Let me just copy this down. I don't want to change the referencing. I'm just going to move this. I'm just going to move this down. Okay, and then we'll just put value here. All right, there we go. All right, so if you look at page 305, just the example, right, they're just showing you, like, this is all the data. Okay, remember, the data is something that you are going to get, right, from the bond contract. The bond will have a settlement date, it'll have a maturity, it'll have all of this information. Okay, I'm using Excel from here. This is Excel. From that point onwards, that's Excel. Okay, I needed to calculate the number of days, okay, in order to get the number of years, in order to get the semi-annual periods, to get the coupon payments, and then I can work out the value of the bond, okay. All right, now I'm going to be looking at a price change, okay. So they're looking at, let's just have a look at the next bit. Okay, they want you to calculate Is it the price change? Okay, yeah, the yield. Okay, so the yield at 9%. Okay, so if you go a few pages on in the textbook, right, on page 307, okay, this is where we're starting with the comparing the different yields. Okay, so now we've got the 9%. The 9% yield will be the same as this. So I can copy this formula. Okay. I just need to change this back to C22. Okay. Okay. I see. All right, let's fix these. $sign. Okay, C22, that one we can change. All right, so let's paste the formula here. Okay, C22. Actually, it'll be B40. Okay, B40 is a percentage, so I can get rid of this divide by 100. Okay, is this a percentage? It isn't a percentage. So then maybe I need to remove the divide by 2. No, it needs to be in a decimal. Okay, so it must be in a decimal. So let's make this a decimal. Okay, so B40 divided by 2. Why is it not accepting it? Maybe it must be a comma instead of a point. All right. What else do I have here? Are those all right? Okay, let's try to do it again. PV, brackets, okay, the rate, divide by 2, divide by 100. No, we don't have to divide by 100 because it's already 0.9. Okay, the N was my number of periods, 40. The payment was 40. The future value was 1,000. It doesn't like this. It doesn't like this amount here. It is a number. Let's try general. Nope, doesn't like it. Okay. Right. Oh, it likes that. Okay, so let's leave it as a whole number. Let's just put some decimals in there. Okay, so this needs to change. Divide by 2, divide by 100. Okay, there we go. All right, so there's the one. Copy. Oh, before we copy, we need to fix some cells. Okay, so everything there needs to fix. Fix that, fix that. All right, copy, paste. All right. Okay, and then we're gonna need another function for the next one. Okay, let me copy it there, it's fine. We'll just change it to D instead of C. So this must be a D. This must be a D and a D. Okay. And then we're using the 9%, so that'll be B40. Okay, and then copy that, paste. All right, so this is 6%. Is it using the right cell? B41, 6%. Why is this figure not right? D29, yes, that's right. D30 is the coupon, and that's the face value. Okay. Did I divide by 2? I did divide by 2. The coupon payment is twice a year. Oh, okay. Semi-annual periods, 20. All right. Do I have the right N here? 20. Yeah, it looks right. Okay. It doesn't work out. Start again. Let's do it again. Okay, so bond 2's price is going to be calculated using the rate. The rate that we want to use is 9%. So 9 divided by 2 divided by 100. Okay, the N is the number of periods, 20, the payment, coupon, 40, the future value, 1,000. Okay, right, I get that figure. What is wrong? Oh, I see. Okay, page 307, the table has changed. It's a 4%. Do you see it's a 4% coupon?
Okay.
You see that? Yeah, on page 307, I'm just wondering why are their prices different? Because I see the coupon is different. Okay, it's not the same question, it's a different question. Do you see that?
Yes.
All right, so let's duplicate the sheets. Okay. All right, so all they've done here, okay, in bond example 2, it's a different question. All right, the settlement date, is that the same? Yes. Maturity date, that's the same? Yes. Okay, that's the same? Yes. Okay, so everything here is the same. It's this column that's different. Okay, we still have a 20-year bond, so copy, paste. Okay, we have a coupon rate of 4%. 4%. Okay, what else? Required return 9, frequency 2, all of that looks fine. Okay, all right, so our first answer here, okay, when the yield is 9%, 539.96, that's correct. Okay, right, let's update the formula here. B41 divided by 2. Okay, we need to fix these cells, eh? So let's fix this one. Fix it, fix it, fix it, enter, copy, paste. Okay, there we go. Now we've got the same thing as the textbook. All right. Okay, then we need to do price change, percentage change. Okay, so to work out a price change using Excel, all right, how much did my price change by? Okay, well, if the yield decreases, okay, so we expected it was now, and then it decreases. So if we expect the yield to decrease by 3%, okay, we would expect the bond prices to increase by that margin. Okay, so the price change is the new price minus the old price. Okay, does it make sense?
Yes.
Okay, did the price increase or rise or fall? It actually rose. Okay, we need to change these around. Let's make these negatives. So we have a nice positive. Okay, did that work? Oh, wrong one. That was 40. 40 was my N. Okay, I can't change that one. I need to change the last two. Okay, the negative should be at the end. There we go. Okay. Just need to reference the right ones. Okay, yeah. So those are positive values, right? Price change, there we go. All right, so now we can just copy that, paste that there. Right, percentage change would be brackets, the current price. okay, minus the previous price, close brackets, divided by the original price times 100. Okay, let's make that a percentage. We're going to have to remove the times 100 then. Okay, copy, paste. All right, is that okay?
Yes.
Okay, so we're just looking at the workings. All right. Duration and convexity, now they talk about it. Okay. All right, on page 309, now we're going to calculate Macaulay's duration. Okay, Macaulay's duration. Okay, the question has changed again, looks like it. Is it still the same question? 907? Oh, it's 10%, yeah. Okay, let me just duplicate this again. Bond example number 3. All right, so it's the same set of data, but the yield has changed to 10. Okay,
Yes.
why? Because of a 1% increase in interest rates. Do you see that?
Yes.
Okay, so you could have multiple sheets looking at different yields. Okay, so now I've got a 9% yield, and now it's 10. Okay, look at all my formulas. See how nice it is? It updated automatically. Do you see that?
Yeah. Yes.
Okay, I can make this 8% changes. I can make it 9%. Okay, I can make this 10%. It doesn't matter. All right, so now I've got that. That's updated. That's updated. We're all good, eh?
Yes.
Okay, so duration. Let's see. Duration. Did they use a formula for this, or did they calculate it using? Looks like they did use a formula. Settlement, maturity, coupon, yield, frequency, and basis. All right, so duration here, Macaulay's duration. Okay, there, duration. All right. Oh, maybe it's M duration. Let's just check what M says. Duration. Returns Macaulay's modified duration. Okay, that's modified duration. Returns investment time to reach, no, okay, so we're just going to use this one, the first duration, not the modified Macaulay's duration. Does that make sense?
Okay.
Okay, so we're going to use normal duration. The settlement expressed as a serial date. Okay, so our settlement date was here. Okay. Our maturity date was here. Okay. Our coupon, the annual coupon rate was here. Okay. The yield was 9%, so the yield is actually here. Okay. And then we need to choose which one? Annual, semi-annual. This is semi-annual, so 2. Okay. Type the type of day basis used to use. Okay, so the basis is 360. We used 360, didn't we?
Yes.
Yes. Okay. So let's just see. I hope I'm putting in. Okay, that's frequency. Okay, next one. Okay, yeah, the basis. Okay, we've got options here. Actual. So I'm going to use actual divided by 360. Okay, close brackets, enter. All right. Oh, that didn't work out. Something's wrong here. Let's check the percentage one. This is 9. This is 8. The two dates are there. Maybe let's change the last one. I think this is a problem. Or let's just leave it out. It does want it, eh? All right, so we do need to include let's put actual as that. Did that work? Too many brackets? No, it's not working. All right, let's just have a look at their example. I think I'm not referencing the right thing. So they're referencing B2. B2 is the settlement date, that's fine. They're referencing the maturity date, that's fine. they're referencing the coupon. Oh, maybe the coupon needs to be a percentage, eh? So I'm going to change that. This 8 should be 8%, so 8 divided by 100.
Okay.
Okay, let's put 8 divided by 100, 0.8. Required return, divide by 100. Okay, there, that's better. Do you see that?
Yes.
Okay, so yeah, these were numbers, they weren't percentages. So I'm just going to put that in red. Okay, all right, those needed to be percentages. I'm not going to change it now because it's going to take too much time to update all of it. I'm just going to divide by 100. Is that all right?
Yes, that's fine.
Okay, copy, paste. Right. Oh, we just need to update the dates. The date is fine. The date is fine. Oh, this needs to change. Is that 4? Yeah, that was 4 and 9. 4. Oh, this one needs to change. Okay, this is referencing. That one we could have fixed that column. This column we can fix. All right, so this column we can fix. B40, I want to fix it. Enter. Okay, copy, paste. Now that's going to work. Yes. Okay, Macaulay's duration, 11.45%. Make sense?
Yes.
Okay. All right. Modified duration. Do you need to calculate that? Yes, looks like you do. Okay, modified duration. All right. So okay, the modified duration is 9.4. In order to calculate the modified duration, you need the price change. Okay, Excel has the M duration function to calculate modified duration. So we can actually use the M instead of having to use what they're giving us there in the formula. Okay, let's go. Settlement dates. Here's settlement dates. Okay. Maturity dates. All right, coupon. Okay, remember coupon? We need to divide by 100. Divide by 100. Okay. Yield. Yield here was the 9%. Divide by 100. Oops. Divide by 100. Divide by 100. Okay. This was a semi-annual bond. Okay, with 360 periods. Close brackets. Enter. Was that good? Nice. Okay. All right. It's correct. We need to fix this B40 cell. That was the yield. Fix it. Copy it. Paste it. Okay. Modified duration 10.9695. Yeah, awesome. Okay. Is that all right?
Yes, that's fine.
Okay. All right. Predicted change. Okay. So the predicted change in price, okay, is the modified duration Okay, so we need to work out this next line. Predicted change in price. Okay, to calculate this, they've used a formula. Okay, it's the same formula that we have in the notes. They're just describing it with these mathematical symbols. I'm looking at page 311 in your textbook, if you're following. Okay, so this predicted change, okay, is calculated using the modified duration. All right, so negative modified duration, okay, multiplied by open brackets, okay. I need to fix the cell. I'm looking at my change in price. So this one, fix that cell minus the original price, this one. Oops, what am I missing? A bracket. Okay, oh, I want to fix the cell as well. Enter. Okay, this was a percentage, eh? Oh, I see. Okay, their table is different now. This is 9.1%. 9.1. Okay, 9.1%. That's correct. That's correct. That's correct. That's correct. Everything else is correct. Predicted change in price minus, what number am I using? C47. C47 is the negative modified duration. That's fine. And I'm multiplying that by, maybe this must be a percentage. No, that's not right. Okay, I've done something wrong here. Let's just check the formula. Let's go back to page 110 just to have a look and see here. Okay, that duration we calculated correctly. There's nothing wrong with that. Percentage change in price, predicted change in price equals negative modified duration times the change in yield to maturity. Oh, okay, I get it. Okay, so we're not using the price, we're looking at the change in the duration, which in this case was 0.1%. Do you see that?
Yes.
Okay, so we actually need to fix this. The change is here. So it was the yield. Okay, the yield needs to change. Okay, so the yield was 9 minus, it was 9.1 minus, so this figure minus this figure. Did that work? Maybe it doesn't like those numbers. It's not a percentage. So let's make this divide by 100. Oh, I think I know what I need to do. I think this is a comma. 9, 0. 9, 0. No, okay, that can't be it. All right, so the formatting is fine. It just doesn't like the formula. Okay, let's delete and start again. Okay, so percentage change, modified duration, times, open brackets, the difference between 9% and 9 points. So I'm going to write this as a decimal, 0.091 minus 0.09, close brackets, enter. That's better. Okay, that's better. Okay, but here this was a change in price. The change in price was positive. So if interest rates increase, then we would expect bond prices to decrease. Does it make sense? So we need to put a minus here. So it's minus cell C47 times the change in rates. There we go. Okay, is that all right?
Yes.
Okay, and then we do the same thing for that. Now just be careful with this one. Reference the percentage. Okay, I'm going to try that again with the formula. Let's just see if it works. Right, so it's negative this times open brackets. It was this divided by 100. Okay, minus this divided by 100. Ah, it does work.
Yeah.
Okay, make it a percentage. Yeah, it is working. Okay, so let's fix those cells. Fix the cell. Fix the cell. Copy it, paste it. Okay. Make sense?
Yes, makes sense.
Okay, great. All right, and that's how you do duration, basically. Okay, convexity. Do they want you to calculate convexity as well? Yes, they do. Looks like it. Let's just go back to the... where's my page here? Okay. We've covered all of this. We're now looking at the next part, convexity. Okay. All right, so we need to calculate convexity. Let's do it. Okay, convexity. Approximate convexity. And predicted change. Okay, so I'm looking at page 315. All right, we need to get convexity here and approximate convexity. Okay, let's do convexity first. Okay, so convexity, we've got a formula, but there should be a function for this. Let's just have a look and see. Convexity can be calculated with, okay, they've given the formula, but they didn't give the actual, oh, I see there. Okay, they included convexity. They've given us the M duration. Looks like we might have to plug this in as a formula, but that's gonna be too long. There must be a convexity equation for this. Let's search. Oops, is convexity a built-in formula? No. Ooh, okay. All right, looks like you do have to do this manually, eh?
Okay.
Convexity. Oh, I see there's a FAM underscore. Did you find out if those are built-in functions, eh? FAM underscore convexity. Did you find out about that from last time, eh? Those FAM ones.
So that one, they haven't responded to me yet.
Okay. My general gut feeling is saying that this FAM underscore convexity, it's an inbuilt function, but so on Excel you can actually use they call it a macro. You can actually use a macro. You can program or you can create these automatic formulas, and you can save them as a macro. So when I see this FAM underscore convexity, I'm thinking it's an actual pre-built function that somebody has created or developed, and then they've used it in this spreadsheet. That's what I'm thinking. So when I see this, just ask them about this. I think it's a pre-built function.
Okay.
Because all I can think of is this is something that you have to do, because you can use the formula, but you have to use what they've given you in the textbook. All right, so here, see, we have to use this equation. If you look at page 314, you have to use the full mathematical equation. Do you see that?
Yes.
See, but then they also say, now enter the formula equals FAM underscore convexity brackets B2, B3, B5, B6, B9, and B10 in B22. Copy this formula to C22. I do think this must be an inbuilt function. It's not pre-built in Excel, but it's one that they've created using these formulas. Does it make sense?
Yes.
Okay. So I don't know where you're going to get that. Did they give you any additional information? Like, was there a set of inbuilt functions that you had to download somehow and then incorporate in Excel, or?
No.
Okay, you're gonna have to follow up with that again and just find out. Please get back to me about that. I'm also curious to know what this is actually.
Okay, no problem.
Okay.
I'll do that.
All right, so that's the convexity. Let's just see if there's anything here. Did they mention anything? All right, duration we calculated, Macaulay's modified, that's fine. Yeah, see here, again, there's it there. Do you see it? Oh, there we go. See, we've answered the question. See, it is inbuilt.
Yeah.
Okay, it is a macro. Okay, it's a pre-built function. It's part of this document. Okay, you're gonna have to ask Unisa for this, eh?
Okay.
All right, this fame FNC.S. This is the so this is a yeah. Okay, so I don't know how to code, but if I did, then you'd be able to create these inbuilt macros, or it's like a developer can do this. So if you know any developers, they can definitely create this code. It's a code that they create separately, and then you incorporate it into Excel. Excel has a, where is it? Let me find it here for you. I think it's under data. There's a macro or a query there. All right, I think it might be this actually. No. All right, let's search for fame here. No, it doesn't. Okay. Yeah, it's definitely an inbuilt function. Let me search for it and then I can just give you a bit more insight. Let's go Microsoft Excel macros. All right, here's a perfect explanation from Google. Right? This is what a macro is. Okay, a macro is a predefined or repeated automated task that you can run multiple times. You've got to use the developer function, okay, in the actual Excel tool, and you've got to write the code for this particular thing. And it can be interactive. You can click things, you can insert things. But so I'm not aware of the coding. I don't know how to code, but I know it's possible. If you do get the code from somewhere, you can actually create it, right? And then you can run the macro in Microsoft Excel as a predefined set of actions. Do you see that?
Okay. Yes.
Okay, so it's possible to create it, but
Yes.
at least now we have confirmation. Okay, you do need a list of these functions. Okay, so we've got it there. Right, now we know where this fame stuff comes from. See, okay, we saw it there. Is that all right?
Yes.
All right, so once you've got the right function from them, you can just insert this using the right, okay, inserts, input, right, and you should get the right answer. Okay. All right, then I think that wraps up this topic. Okay, there's a little activity here to try. Oh, the dividend discounting. Right, this is nice. This is easy. Okay. Oh, but they want you to use the fame as well, predetermined. Do you see that?
Yes.
Okay, so you can use the predetermined, but it's not that bad. Let me just show you with this example then. Oh, this is bond valuation. Okay, this is the same example as before. The dividend discounting starts there. Okay. Do we have an example here? No, but there's one on page 272. Let's check what's on 272. Okay, yeah, there's the 3-step and 2-step. Yeah. Okay, this is good. Okay, but yeah, they've given you these pre-built functions because they want you to use this data here. All right, so let me just create a note about this. Okay, so bond 1, 2, let's call another sheet here. This is share valuation. Okay, page 272. All right, they've given you EBIT here. Do you see that?
Yes.
They've given you all this data. So this is actually just the accounting, eh?
Yes.
And then you've got to use the accounting to get the amount that you need to use in the calculation for the dividends. Right, so basically they're just using some finance or accounting. They've given you data, but then they've asked you to calculate the dividends using the dividend discounting. market value of debt, WACC, growth, FCF, shares outstanding. Okay, so EBIT, is that all right?
Yes.
Okay, it's just data.
Yes.
Okay, growth. Oh, I missed one. What is it? 12%. Okay, the market value was 450. Shares outstanding. Okay, and then you've got all of these line items. Net profit after tax. Some of these I think you can actually work out. So these ones you could work out if they gave you more information. Value of the firm, like for example, value of equity, okay, per share value, I could use the equity and I could divide that by number of shares. That should give me the same answer. Let's see. Oh no, it doesn't. Oh no, it does. Yeah, it does. Do you see that?
Yes.
Yeah, so you could calculate some of these values based on the data. If they gave you more information, if you had a spreadsheet, remember we spoke about pro forma financial statements and stuff?
Yes.
Right, you can create these equations and then you can draw them up. Right, so that's what they're looking at there. And then they've given you some examples and then the 2-stage, 3-stage valuation. But they want you to use those functions. Okay, there's that fame. Fame. 2-stage, 3-stage, 3-step, 3-stage, and H model. Do you see that? That's on page 278. Using the inbuilt functions.
Yes.
All right, will you be all right with those functions?
I don't know. I think I'm gonna have to go through it,
Yeah.
and then maybe if I'm struggling, I can just ask you to assist me.
Okay, because yeah, they're inbuilt functions, and I can see that they're using like dividend 1 is the next dividend. The required rate is your RR, your growth rate is your G,
Yes.
and then you've got the periods. Do you see that?
So
this is
once
2-stage, so this is growth rate 1 and this is growth rate 2, and then this is your period, so N.
Okay.
Yeah, so
once I have this inbuilt functions, then it will just literally be like quite simple, basically, to just do that.
Yeah, you'll be referencing it like in a normal formula. So if you go here, for example, like here, this duration, okay, wherever we had these inputs, we would just replace it with a number.
Okay.
Okay.
So
right, but if you get stuck,
difficult.
Yeah, if you get stuck, you can let me know that we can see, yeah, what this looks like. All right. Okay, so these are all those inbuilt functions using Okay, whack. Sum product, okay, that's good. Cost of equity, that's good. Is there an example here? Page 341. Page 341. Ah, here's whack. That's good. Okay, here's a nice example. All right, whack starts here, creating a marginal whack chart, and you've got the curve there. Okay, 341 to 345. There's the summary, calculating the sum of the product. Okay, that's good. That we can do. All right, so the whack, we need to calculate whack using these arrays. Okay, so we have total capital, cost of capital, preferred stock, cost of debt, and we've got whack. This is the marginal whack curve. That's just explaining, do you remember whack from FIN?
Yes, it's the structure, hey, of the...
It's the cost of capital, and when you accept more projects, the cost of capital increases.
Oh, yes.
Okay, the whack, the marginal whack, is looking at an increase. So when you take out capital, if I want 1 million, 2 million, 3 million, 4 million, every time I take out more capital, it starts getting more expensive. Make sense?
Yes.
Okay, because you might start with maybe more debt or less equity, or more equity and less debt. So it's a balance between debt and equity, and the whack is just looking at that weighted cost.
Okay.
Right, so that's the theory. Let's have a look at the working. All right, so they want you to cover page 341 to 345. All right, they've introduced the sum product function, which needs an array. We need to definitely draw that up. Okay, let's find an example. Oh, it's very short. It's just looking at this table, after tax costs, and you've got the debt, calculating the sum of the product of corresponding cells. Return the smallest number in the range. Okay, so let's use a set of data here so we can demonstrate this. Okay. All right, so I'm using page 341. All right, total capital. Pref shares. And whack. Okay, so this is what we've got. All right, so I'm using capital. As I continue to use more capital, the cost is going to increase. Okay, so they're showing you that here. As I use more capital, these numbers get bigger until 900,000. So I'm starting at 0 and then I'm raising capital. So cost of equity when I start is 12 points. Let's just make them all percentages. $12.31. Okay, copy paste. Then you've got 15% for how many? For a lot of them until the last two. And then you've got 17% here. Okay, preferred stock, cost of preferred stock was 10.2. Then 13. That's it, hey? Are you still there?
Yes, I'm
Okay,
here.
all right. Just wondering, it's very silent, so I was just checking. Okay, all right. And then 8. Okay, and then the WAC, 10.51, 10.51, 12.13, 12.37, 12.65. Oh, 37 is twice. 12.65 twice.
Yes.
And then 13.85. Okay, so we've got a set of data.
Yes.
Right, so let's use these functions. What is the first one? Calculate the sum of the product of corresponding cells. Okay, so let's use that here. There, sum product. Okay, returns the sum of the products of corresponding ranges or arrays. Okay, so you have arrays to multiply and then add the components. Okay. All right, so let's do that. So this will actually calculate the WAC then. All right, so sum product, bracket, array 1. This is array 1.
Okay.
Okay. With array 2, 3, 4. Okay, I'm going to highlight with the titles as well. I don't think it'll work because the titles are there. If it doesn't, I'll
Yes.
remove it. Let's
Okay.
see. Okay, that gave us this figure of those arrays. That's the multiplication. I don't think it worked out the... Okay, let's reference page 326. In the textbook, it says go to page 326. Let's go to page 326. Let's see what this function does. So we have the right working. Okay, yeah, WAC calculations in Excel.
Yeah.
This is better. Calculating the components. There's sum product. Okay, so here you actually need the specific amounts to do the arrays, right? Because here they've given you an example, E2 to E4, which is debt and preferred stock, and then they've given you F2 to 4, the sum of the product. So they're multiplying the total percentage times the total cost. Okay, so let me show that here.
Okay.
All right, so you've got percentage of the total, and then you've got the after-tax cost. Okay, right, for debt, preferred stock or preference shares. Okay, there we go. All right, so this was 31.14 percentages again. Right, so this function is just going to multiply one with the other. Does it make sense?
Yes.
Okay, so remember when you're looking at WAC, it's weighting times cost. Remember that?
Yes.
Okay, but obviously for all the different components, right?
Yes.
Okay, so weight times cost, weight times cost, weight times cost. weight times cost, weight times cost, weight times cost, again and again and again. Agree?
Yes.
Okay. Right, so when you're looking at a weight times cost, I can actually use the sum product function. Okay, and I can take this and I can multiply it with that. Right, and I'm going to get this answer, which as a percentage is this.
Okay.
All right, do you see what that does?
Yes.
Okay, so in this example, to calculate WACC here, all right, I've got the total. I need another column here. So let me just add a column here. Okay, this is the cost of equity, cost of preference shares, and cost of debt. Here I need a percentage. Oh, we don't have the percentage. Remember, this is the total capital. I don't have the portion of equity and debt and shares. Do you see that?
Yes.
I need the weighting. I need the weightings for all of them. Does that make sense?
Yes.
Okay, and then you would multiply that using the formula. Okay, so weighting for equity. Okay, I see that's not given in that example. All right, so whatever it is, so for example, in this one, I had the
Yeah.
percentage total here and I had the after-tax cost here. This times that. So have a look.
So
This
tell me, Anthony,
times
do we,
that.
okay, sorry,
Yeah.
do we get this information or are we supposed to work this out?
Well, it depends on the question. If they give it to you, if they just give you debt and equity, then you have to use page 326. So 326 will give you, this is page 326. Okay, page 326 will give you the weightings. The weightings are based on the totals.
Okay.
Okay, look at page 326.
Yes.
How much debt did they have? The price was 904. The number of units was 40. So to work out the total market value, they multiplied the 400 by the 904. Does that make sense?
Yes.
Okay, on the calculator here, 904.53 times 400 gives you this amount. See that?
Yes. Yes.
Okay, then they got the total, then they got percentage of the total, so they added it all up. So this amount divided by the sum. The sum here was 1161812. Do you see that?
Okay.
See, that gives me the
Yes.
weighting.
Okay.
See the weighting?
Yes.
Okay, so this was debt. Then the total was this figure here. Make sense?
Yes.
Okay, and then percentage of total. All right, and then obviously you got the
Okay.
cost.
Yes.
All right, so with the cost, it's the sum of the product. So you're taking the one and you're multiplying it by the other. Let's see sum of the product. Sum of the product, E2 to 4, E2 to E4, and then F2 to F4. That's the sum of the product. That's what they did here
Yes.
in this array to work out the weighting. No, not the weighting. What does it say here? Sum of the product function, which is defined as equals sum of the product, where array 1 and 2. This function multiplies the corresponding values in each array and then adds together the results. Okay, so multiplies the corresponding values in each array and then adds together the results.
Okay.
It is perfect for calculating weighted averages as we are doing here. We can calculate the WACC in cell F5 with the formula sum product E2. So E2 is the percentage, okay, to an F2, an F2. All right, so this and that gives me the WACC, which was 10.27. Okay. All right, 10.27, delete this. Okay. This is looking at debt, equity, preference shares. Do you see that?
Yes.
Okay, so this 10.27 is looking at the weighting times cost plus weightings times cost plus weightings times cost plus weightings times cost. Does that make sense?
Yes.
Okay, so in this scenario, okay, look at the long formula. It would have been brackets this times this, close brackets, plus this times this, close brackets, plus this brackets, this times this, close brackets, plus. See?
Yes.
Does that
Yes.
make sense?
Yes. It's just a simpler way of doing it.
100%. Okay, so this is the WACC. Okay. WACC for the components. Is that all right?
Yes, that's fine.
Okay. All right, let's go back to that page. What was that other function? 340, what is it? 345. Was there another function there?
Yes, I think there was something else.
Where were we? Page 345, I think, hey? 341. Yeah, 341. Oh, small. Return the kth smallest number in the range. Okay, so look, small. Let me show you what this does. All right, here's the range.
Okay.
And we need to show the k. So k is the position from the smallest in the array, is the position from the smallest in the array. Does that make sense?
Yes.
So let's look for the smallest, so 1. Okay, what's the smallest value here?
The 7%.
Exactly. Look what it returned.
Yes.
Okay, so smallest value, 1. So this was the smallest. Right, how many values do I have here? I have
6.
6 values. So let's do equals small, comma. Let's do number 6. It'll give us the biggest value. See that?
Okay.
Okay. Does it make sense?
Yes.
Right. It's just fancy Excel formulas, yeah.
Yeah.
Okay, I think we've covered all of that. All right, these are just functions that you need to build, just using your knowledge of equity valuation. I don't think there's anything here. This is just calculating, this is just individual workings. Okay, remember rate, okay, is a percentage. This is time value of money, hey?
Yes.
In payment, FV, PV, hey? You're just finding I.
Yes.
Okay, so that's what you use to get rates for any of these.
Okay.
All right, this you've actually covered before. I just want to show you how to do it using Excel. It's not going to take long. NPV and IRR, it's actually quite easy. You just need to draw up a table. This VLOOKUP, I'll show you what it does. It just finds a value in a set of values. Let's get an example. Okay, we need a corresponding example. Let's use one in the textbook rather. It's better. Let's see, we're looking for a page number here. Estimating cash flows, 368. Let's see if we can use anything there. NPV. Okay, yeah, there we go. Modified internal rate of return. That's good. Here's the project. Okay, yeah, this is good. Okay, so page 368. All right, so last bit of NPV and IRR. Okay, so you've got period A, B, C. Okay. Negative 1,000. Oh, this is minus, so this minus this. Okay. All right, 0, 200, 300, 500, 900. Okay, is that it? Yeah. Okay. All right, so now we need to work out these values here at the bottom. Okay, based on the data that we have here. Okay, so in order to calculate NPV, okay, just be careful here. There's two. Returns the net present value of an investment, and this returns a net present value for cash flows. So use this one for cash flows. Okay, the rate here, we need a rate here. It looks like 10%. Page 368, just before the table, they say required rate of return is 10%. So I'm going to put that up here. I'll reference it just now. And then the values, the series of cash flows that correspond to schedule of payments and the date. Okay. All right. %. Did that work? Oh, too much. Oh, didn't work. Let's try that again. All right, the rate needs to be a decimal. Okay, so let's make this a decimal. Oh, number. Okay, 0.10. All right, so let's try the other one actually. Let's use this one first. Should still work. Oh, but you need to show each value separate. Okay, instead of an array. Yeah, it'll work. Maybe this one's easier instead of using the different references. But now you need to choose each value. So I'm going to choose each value. So comma, 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 close brackets. All right, I see it's a bit off, eh? Why is it off? Are the amounts correct? 0, 200, 300, 500, 900. Looks right.
Yeah.
Change. Let's try the NPV with the other one. We should check this on the calculator actually. 0.10, comma. All right, values, values, values is a series of cash flows that correspond to a schedule of payments in dates. Is a schedule of payment dates that correspond to the cash flow. Okay, so this, this. That's it. No, not working. All right, why? Let's see. Maybe this must be a date. Let's see if we put dates here. No, that's not going to work. Okay, with NPV, remember we're going to look at the present value for the observation. So I can check it, PV brackets, the rate is 10%. Okay, the N will be this one. Okay, the payment is 0. The future value is this. Okay, right, and then you'll calculate that figure, and then you will do that for all of them. Right, and then you will sum up. Right, yeah, that's the correct NPV. All right, it should be 291.02. Right, this you can calculate on your, this needs to be negative, hey?
Negative, yeah.
What did I use here? PV, PV of C4, which is negative, so we need to make it a negative. That needs to be a negative. Copy all of that. Okay, that's better. All right. Okay, on your calculator, can you do the net present value quickly? Just check it. If you type in all of this with 10%, do you get the right NPV? It should be right. This looks right to me. This one doesn't look right.
Okay, let me try.
Let's check IRR. IRR for all the values. Okay. Ooh, wrong one. This one. Ah, okay. IRR is fine. Okay, so IRR is fine. That's the function for IRR. It's just this. That's a different NPV. Maybe I need to make this negative. It is negative. Negative, positive, 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 positive. All the values are there. NPV 10. Let me write a 10 instead of a 0 point. No, that's too big. Okay. This X NPV, let's just check in the textbook. This NPV that they're using. Do you still remember how to work out NPV on your calculator? Hey? Did you get the same value?
I do know how to work it out. I just need to refresh my memory.
You've got to use the cash flow function.
Yes.
Cash flow enter. You've got the sharp, right?
Yeah.
Yeah. So I think you put the numbers in, cash flow, numbers, cash flow, numbers, cash flow, and then you've got to, I think, press enter, and then you've got to press equals down or something. Don't know if you remember how to do it.
I have it in one of my notes.
Okay. Let's just check sharp here quickly. NPV on the sharp.
Okay, can I just go get my notes quickly?
Yeah, of course.
Okay.
Yeah, get it quick just to check it. We can just make sure this is right. I'm just going to look at the textbook here just to see what this NPV formula is, the right one, to get the right amount. Because I see the normal NPV didn't give us the correct answer. Okay. Okay, yeah. So on page 363, it says net present value in the textbook. Yeah, the present value of future
It's
cash flows minus the initial
29312.
investments.
Sorry. Yeah, I did do it on my calculator and I'm getting the same 291.02.
Yes, yeah. So that is the correct present value. Why? Because net present value is the present value of the future cash flows minus the initial investment. Remember that?
Yes.
Okay, so all I've done here is I've taken the initial investment, this, I've present value all of those future cash flows back in time, and then I've added them all up. All right, so yeah, that's the correct answer. So this, I'm using mathematics to work out these ones. I'm using the present value. Can you see that?
Yes.
Okay, and then once I've got the PV, then I just add them all up to get the NPV. So this is the NPV. The NPV here is correct. But now the problem is getting it on Excel using their function. But IRR is simple. That one is correct. That's the right IRR.
Okay.
IRR, just take the values, enter. Okay, so that's easy to calculate. The problem is when you do that for NPV, it doesn't give you the same answer as the one that you get on the calculator, which is a problem. So now we need to check what is the function that Excel needs to get the right NPV. Let's have a look. Oh, okay, there I see. To use NPV function for this problem, it's on page 365. Right, equals NPV brackets. B17, what is B17? They're referring to a table. Where's their table? B17. That must be a previous example. B17 is the required return. Okay, I see. All right, so on page 353, okay, the required return.
Oh, okay. Yes.
Required return is 15%. Okay, so when I'm looking at cash flows, then we need to go to the right page. So back to the page that we're looking at. Okay, so you have cash flows here. Cash flows for a period. And then you've got NPV. So they said to calculate NPV equals B17, and then you've got D20 to D24. D20 to D24. Where's D20? D20 to D24. D20 to D24. Oh, okay. And then you add the 19. Okay, that's fine. All right, I see how to do it. Okay, so, all right, NPV equals, okay, this is how you do it. All right, equals, you reference the rate. So the rate here was 10%, eh?
Yes.
Okay, so NPV, open brackets. Okay, the rate was 10%, so 10%, I'm going to use the 10%. Close brackets, then I need to highlight the array, okay, without the initial investment. Close the bracket, then I need to add this amount, enter. Okay, now it's correct. Just make it a number. All right, there we go.
Okay.
All right, so this formula here, let me copy the formula. All right, that's what you type into your equation. All right, so the C1, this C1 is the rate, okay? And then you've got your data, Okay. Oh, it doesn't keep the color. All right. It keeps the data. Okay. All right. I think that's okay. Can I leave it like that?
Yeah, I think that's fine.
All right. And then just the yeah, so it's basically just highlighting the cash flows. The cash flows is part of the NPV brackets, but you still need to add the initial investment to get the right answer. Okay, because those two answers need to match. Okay, so this one is obviously incorrect. I'm going to delete that. Let's fix it. Let's do it again. Equals. Okay, NPV, open brackets, choose the rate, close brackets, choose the cash flows, okay, close brackets, and then add your initial investment, enter.
Okay. Yeah.
Okay, so now they balance it. Yeah, it must be correct. It must be the same answer. All right. And then just with VLOOKUP, I see there's just one other note in the textbook. When you have a VLOOKUP, all right, VLOOKUP returns the first search result in a vertical list. So with VLOOKUP, you're just finding something in an array. So if this was the array, okay, I'm looking for a value. Let's assume I'm looking for the value. Let's say I want to know what the value is for B, okay, for period 3. So I'm going to look up value 3, okay, all right, in the table. So the table, okay, these are like it's a table. So I'm gonna highlight this whole array like that. Okay. And then I want it to find the column. Which column do I want? This is column 1, this is column 2, this is column 3. So I want column 3. Okay. Enter. Right. Notice it pulled this figure.
Yes.
Okay. Does that make sense?
Yes.
Okay. So with VLOOKUP, right, all it does is it just brings you a corresponding value in a specific column that links to what you're observing. So I'm observing, okay, period 3, and I wanted 300. Does it make sense?
Yes.
Okay, so you could say VLOOKUP, okay, you could say search for, all right, give me the value, look for 4, okay, in this array, okay, and give me the answer in column 2. So A, it's going to give me 500. Do you see that?
Yes.
Okay. So this is corresponding to this and that.
Okay.
Make sense?
Yeah.
All right. So VLOOKUP is just a function that can help you find important data in a massive set of data. This is a very small set of data, but if you had a massive set of data, maybe I'm looking for like a student name, okay, and their corresponding mark for a specific subject, then I can just call that.
Okay. So it just assists you trying to find.
Yeah, it's an easy way to locate specific data in a massive array.
Yes.
Okay. And I think I've covered everything. Let's just go back and check. Now, that was the last thing I saw here was the VLOOKUP. Okay. Is that all right?
Yes, that's fine.
Okay, and that's the end of the textbook chapter, looks like. Yeah, they're just talking about NPV and IRR. Just remember NPV, accept when it's greater than 0, hey? Positive.
Yes.
Reject when it's negative. IRR, remember to compare it to WACC, cost of capital.
Yes.
All right, and then this is just an analysis. This is modeling. We spoke a little bit about this previously, where you can create a budget or any analysis where you've got different scenarios and different inputs. Right, there is an example here. Let's just have a look and see what the example looks like. I suspect it's like a spreadsheet with different data. Let's see what it looks like. Page 393. Yeah, this is statistics, eh? This is probability and cash flow. They gave you the coefficient of variation. Yeah, so you can use stats to work that out, okay? Or you can use a spreadsheet where you've got those inbuilt functions. And they've given you a nice whack here, tax rate. There's a nice example here, Exhibit 13.1, page 396.
Yes.
All right, that's just an example. I think you'll be all right with that, eh?
Okay.
Looks fine. It doesn't look like there's any additional formulas. It's just a cash flow. Okay, here's a nice one on the last page. Here, page 398 in the textbook. Okay, annual cash flows for frozen catfish fillet project. Right, you've got the initial outlay, okay, year 0, and then you've got year 1, 2, 3, 4, 5, and they've shown you all the different costs that they've provided for. Remember, when you're working out cash flows, you need to take out depreciation, eh? Remember that?
Yes. Yes.
Okay, and then you solve and you find the answer. Make sense?
Yes.
All right, awesome.